As we look at the boards right now, on Thursday, December 18th, 2025, Caterpillar Inc., trading under the ticker CAT on the New York Stock Exchange, is currently priced at $559.79 USD. This represents a significant intraday drop of 28.99 points, or about 4.92% since the opening bell. This downward pressure is hitting the stock hard today, especially considering that just a few sessions ago we saw this name testing fresh heights. If you were watching your individual brokerage account or checking your positions on the Robinhood app, this move likely stands out as a stark contrast to the broader market momentum we have seen in sectors like tech, where Nvidia stock and Apple stock often dominate the headlines. While most people are looking at this nearly 5% drop as a simple correction after a massive run, the reality is much more complex. The immediate insight most people are missing is that this sell-off is not just about profit-taking. It's actually a massive repositioning by institutional players who are reacting to specific shifts in global trade policy and manufacturing data that just hit the wires. The common expectation among many who use online investing platforms like SoFi Invest or Fidelity Investments is that Caterpillar is a safe, slow-moving industrial giant that acts as a proxy for global growth. People see the big yellow machines and think of steady infrastructure spending. However, the reality we are seeing today challenges that belief. Caterpillar has become a high-stakes play on global energy transitions and high-tech mining, making it far more volatile than the traditional blue-chip narrative suggests. If you look at your Schwab Intelligent Portfolios or other automated investment tools, you might see Caterpillar categorized as a value play, but its recent behavior looks more like a growth stock on a roller coaster. This disconnect between the perception of CAT as a steady utility-like entity and its reality as a cyclical beast influenced by volatile data center energy needs and mining commodity prices is exactly where the risk and opportunity lie right now. Looking at the recent stock movement, the daily swings have been aggressive. We are coming off a period where the stock reached an all-time high near 626 USD just last week. The volume today is significantly higher than the 30-day average, suggesting that this is not just retail selling on the Robinhood trading platform. Large blocks of shares are moving, likely from institutional portfolios managed through Interactive Brokers or Fidelity Wealth Management. This high-volume selling often signals a shift in sentiment among the big money managers. When you see a drop of nearly 5% on heavy volume, it tells you that the market is reassessing the near-term catalysts. We have to look at the sector momentum as well. The industrial sector has been grappling with a contraction in U.S. manufacturing for several months now. Even though Caterpillar has outperformed many of its peers like Komatsu or Terex, it cannot remain immune to the macroeconomic pressures of high interest rates and fluctuating demand in the Chinese real estate market. In the third quarter of 2025, the company actually reported a return to revenue growth, which was a big deal after 6 quarters of declines. They saw a 10% increase in sales, hitting $17.6 billion. This was driven by higher volumes across all 3 of their primary segments, something the market hadn't seen since mid-2023. This is why the stock took off toward those $600 levels. But the tension here is that while the earnings were strong, the operating margins showed some strain. Manufacturing costs have been climbing, partly due to the impact of tariffs and logistics complexities. Many investors using online investment sites or the Fidelity mobile app might have missed the fine print where the company mentioned these rising costs. The market is now weighing that revenue growth against the reality of squeezed margins. It's a classic case of the expectations of a continued breakout hitting the reality of industrial friction. Institutional activity has been a major driver behind the recent volatility. We've seen significant inflows from exchange-traded funds, specifically Fidelity ETFs and other industrial-focused funds, which pushed the price to its recent peak. However, when the manufacturing index shows continued weakness, those same funds are often the first to trim positions to manage risk. This creates a feedback loop where the selling triggers more selling. For those of you who manage your own portfolios through self-investing, seeing these swings can be jarring. If you're used to the relatively steady climb of something like Tesla stock, the sudden 5% drop in a heavy industrial name might feel like a signal of a deeper recessionary threat. But again, it's important to separate the noise from the signal. Caterpillar is currently trading at a price-to-earnings that many analysts consider high for its historical range, which adds another layer of tension to the current price action. To understand where we are going, we have to look at what Caterpillar actually does and how it makes its profits. Most people know them for construction equipment, but their energy and transportation segment is becoming the real engine of growth. They provide engines for locomotives, ships, and most importantly, backup power for data centers. This is where the tie-in with the tech sector happens. As companies expand their AI capabilities, they need massive amounts of reliable power. Caterpillar's partnership with companies like Vertiv to develop energy solutions for data centers is a massive departure from their traditional bulldozer roots. This business model is much more resilient to standard economic cycles because the demand for data and energy is relatively inelastic compared to house building or road construction. However, the construction industry segment still faces headwinds. The downturn in China has severely impacted the sales of large excavators, which was historically a huge profit center. Earlier this year, the company also issued new debt through Caterpillar Financial Services to stay liquid and continue their aggressive share repurchase program. They've been very consistent with their dividend, maintaining a payout of $1.51 per share recently. This consistency is why they're a staple in many Fidelity IRAs and other long-term retirement accounts. They have increased their annual dividend for over 30 consecutive years, which places them in the elite category of dividend aristocrats. For many investors, this dividend is the anchor that keeps them from selling during days like today. But for a trader on a Robinhood app looking for quick gains, that dividend might not be enough to offset a $29 drop in a single day. The reality of being a dividend-paying giant means they have to balance returning cash to shareholders with the massive capital expenditures required to stay ahead in the technological race for electric and autonomous mining equipment. Looking ahead, there are several catalysts and risks that could shift the narrative again. On the positive side, if we see a significant stabilization in the global manufacturing sector or a surprise boost in infrastructure spending, Caterpillar is perfectly positioned to capture that upside. Their order backlog remains strong, hovering near the $30 billion mark. This provides a safety net for revenues even if new orders slow down temporarily. However, the risks are equally prominent. Geopolitical tensions and the threat of increased tariffs could further drive up manufacturing costs. If the global economy enters a sharper downturn than expected, those high-tech mining and energy projects might be delayed or canceled. This is the expectation versus reality loop in action. Investors expect the data center and energy transition to carry the company through any weakness in construction, but the reality might be that the construction drag is too heavy to ignore. The way you approach this stock depends heavily on your investment horizon. If you're using a Fidelity trading platform for active trading, today's move might look like a short-term breakdown of technical support levels. If you're focused on long-term wealth management through an individual brokerage, you might see this as a chance to add to a high-quality name at a discount. We have seen this pattern before where Caterpillar sells off on macro fears only to bounce back when the actual earnings numbers prove the resilience of their diversified business model. The company is currently aiming for a 5 to 7% revenue growth target through 2026, which is an ambitious target for a company of this size. Achieving this will require near-perfect execution in their energy and transportation division to offset the volatility in resource industries and construction. Comment below how many shares of Caterpillar you currently hold in your portfolio. Are you holding through this dip, or are you looking to exit and move that capital into something else? I'm curious to see how many of you are viewing this as a buying opportunity versus a warning sign for the broader economy. In the next few months, keep a close eye on the interest rate environment. Since Caterpillar's customers often finance their massive equipment purchases, high rates are a direct headwind. Any signal from the central banks that rates might stay higher for longer will likely put more pressure on the stock. Conversely, a pivot toward lower rates would be like rocket fuel for their construction segment. You should also watch the monthly manufacturing reports and the earnings of their closest competitors. If Komatsu and Terex start reporting similar margin pressures, it confirms that the problem is industry-wide and not specific to Caterpillar's management. For those of you using Robinhood crypto or other high-risk tools, remember that even a blue chip like CAT can have days where it moves with the volatility of a small cap. The trading fees on some platforms might be low, but the cost of missing a major trend shift is much higher. Using tools like Interactive Brokers Trading or SoFi Active Investing can give you more data, but you still have to interpret that data correctly. The data today says that the market is nervous about the high valuation of industrial stocks in a cooling